Okay, welcome everybody to the Economic Club of Miami's, first event in the fall here. We really appreciate you being here. I'm Francisco Gonzalez, the Executive Director of the club, and we have a fantastic conversation here tonight. Just for those of you who are maybe new here tonight, if you're not familiar, the Economic Club of Miami has actually only been around a couple years, founded by our 4 current board members. I don't see any of them here yet, but I know Lourdes Castillo and Jeremy Schwartz should be making their way here. John Hartley and Jeb Bush Jr. are both out of town today. Anyway, they all send their greetings, and hopefully you'll see Lourdes and Jeremy before the evening is out. The club is a membership club, but we also do a lot of public events like this for those who want to join some of our events. But for those who are members, as you know, we do some members-only events throughout the year. We've been increasing those as we've been growing the club this year. So just a few weeks ago, some of us were actually at the Federal Reserve Bank of Atlanta's Miami branch office, where we got a private tour of the cash vault. That was pretty cool. I could actually still smell the money on me, and it was really, really great. They have so much money there, they shred it every day, and some of us took home some of that shredded cash. But if you'd like to join our membership, the information is on the website. You can go to, just Google the Economic Club of Miami, and you'll find us there. And there's a membership application on there as well. Once you send that in and you're invited to join the club, you get access to all of our events, our public events, as well as our member-only events throughout the year. So I think it's a great deal. We also, for those that are interested in sponsoring any of our events or even sponsoring the club throughout the year, please talk to me after the event as well. We have a couple of really great events coming up. Our next public event will actually be October 16th. We're very fortunate that the Miami-Dade College, really grateful they've been able to host us for this event and several of our really nice events earlier. This April, we had the Federal Reserve Bank of Atlanta's Vice Chair and Research Director, Dave Alteg, sitting here on stage with our Chair of our board, John Hartley. We have that video on YouTube at our YouTube channel. So just go to YouTube and Google, search Economic Club of Miami. You'll find us and watch that conversation with Dave Alteg. But we also hosted Ken Griffin and the Mayor of Miami just in the other building here on campus with over 400 people last November. So really grateful and thankful to Miami-Dade College for hosting us. So they're going to be hosting us again October 16th, but not on this campus. We're going to go down to Little Havana. They have a beautiful campus there, which I got to visit recently, the Padron campus. And it's going to be fitting because the title of our next event is called Immigration and Miami's Economic Future, and what better place to have that conversation than Little Havana. We'll be joined by Daniel DiMartino. Daniel's a member of the Economic Club of Miami, even though he lives in New York, and where he's getting a PhD in economics from Columbia. He's also the co-founder of the Dissident. Daniel hails from Venezuela originally, so he'll be talking to us a lot about why we really need to pay attention to economics before things go south like they did in his home country of Venezuela. I want you to also mark your calendars for February 2nd. We're going to be doing a day-long event on a Friday, February 2nd, and it's called the Miami Economic Forum with a major focus on emerging markets and a special focus on Latin America as well. That'll also be hosted at the Miami-Dade College in Little Havana in their big ballroom on the top floor there. So it's going to be a really great event, February 2nd. Please don't miss it. A full day, a lot of talk on investment and finance, and some of the great things to be looking forward to in what you might be investing in the future. So I want to now just call up before I'm going to introduce Robert Foran, and he is the John Cordry Endowed Teaching Chair in Economics here at Miami-Dade College and primarily teaches principles of macroeconomics. So thank you, Robert, for being with us.
Thank you. Good evening. I'm Jeff Foran. I teach economics here at the college, and on behalf of Miami-Dade College and my fellow faculty members, I'm just here to welcome you and to say that we're very pleased to host this event and your very illustrious panel, and we hope to host more of your events in the future, and we want you to think of this as your second home. I teach economics here at the college for quite a number of years, more than I'd like to remember now, I think. Mostly macroeconomics and primarily to first years. So the theme of tonight's talk and your panel's discussion resonates with me. I think you need this broad expanse of time to think about Adam Smith's work and how it influences modern economic thoughts and ideas. So I'm also the faculty director of our student-managed investment fund, and I find Smith's ideas at work there too. We're fully student-centered. I don't think Smith would have used that term, student-centered. I think he would have used liberty or liberties. I think the ownership that we give the students in making the investment decisions for our fund builds leadership skills among the students. It promotes productivity. And I think all of this together really speaks to Smith's notion of the common good, which I think is something that mainstream talk about Adam Smith and his ideas forgets about. That's like. I want to extend a welcome back to Mike McGlone, who's here, and I think a member of your club. And it's because I thank Mike so much for being a real mentor to my students over at Bloomberg, and the college really appreciates that. I also want to extend that invitation to any of you here. I've already met a couple of people tonight that have taken me up on it to come back and talk to our students and have a conversation with them, hear about what they're doing, their ideas, and they would be interested in learning about your experiences in life and your business models as well. We're very interested in continuing the tradition here at the college of preparing our students to transition to the best schools, which I'm sure our panel all attended. But we're also focused on giving the students quality experiences that I hope personally will lead to internships along the way. So again, welcome, and I hope you enjoy tonight's evening and presentation.
Okay, now I get the opportunity to introduce the moderator of our panel, who's also a member of the Economic Club of Miami, one of the originals, and that's Rodolfo Milani, who I also consider a friend, longtime friend. And, you know, Rodolfo was born in Argentina, so I made sure we had to have some empanadas here tonight. You know, he provides investment advice to companies and high net worth clients throughout Latin America and the United States. He has more than 40 years of experience in the industry, and he's previously held senior positions at Merrill Lynch International, Kidder, Peabody and Company, Donaldson, Lufkin and Jenrette, Credit Suisse, Dominic & Dominic, and Wunderlich, acquired by B. Riley in July of 2017, where he is currently at. He received his BA from the University of Texas at Austin and his MBA from the Thunderbird School of Global Management. He's a frequent speaker and panelist on investment-related topics and Latin American issues at conferences around the world. Rodolfo is the president of the Friends of the Universidad Francisco Marroquín in Guatemala, and if it was not for him, I would have never been introduced to that college where I ended up being a visiting professor, so thank you, Rodolfo, for that introduction. He serves in numerous organizations that support free market ideas, including the Hispanic American Center for Economic Research, and is the founder and chairman of the Miami Freedom Forum. He's a member of the Distinguished Mont Pelerin Society and a member of the board of directors of the Inter-American Institute for Democracy. So Rodolfo has also, in addition to all of that on his resume, he's responsible for getting all these guys in the same room with us tonight, so thank you so much for turning it over to you, Rodolfo.
Okay, thank you. Good evening. As Francisco said, my name is Rodolfo Milani, and I'm a senior managing director at B. Riley Wealth Management. I've been a professional money manager for 44 years now. It's my great pleasure and honor tonight to be the moderator for a panel composed of some of the most illustrious people on Wall Street. My job this evening is to set the table by showing where we are now, where we have been recently, and to put forth a few questions that I'm sure our panelists will answer in their presentations. First, let's look at a few pictures of the last couple of years. The time frame on all these graphs starts at the beginning of 2021. First, this is the Dow Jones Industrial Average. What's happened since the beginning of 21. Here we have the S&P 500. Now we have the NASDAQ. Okay. And we have also, what's next here? I can't see what I'm looking at here. So this is shows the three indices on a percentage basis superimposed on the same graph. Then we have the Treasury rates, the interest rates on 1, 10, and 30-year bonds. This is the 30-year mortgage rate, which has really been alarming a lot of people recently. And this picture here is the price of Brent crude oil and what's happened with that recently. And then finally, this is the U.S. retail gas prices. Now, the questions that I hope our panelists will answer for us tonight are the following. Number one, does the rally we saw in the first half resume in the last quarter? Number two, were the bank failures earlier in the year isolated cases or canaries in the coal mine? Number three, we all used to be deadheads, now we're Fed heads. Is the Fed likely to get it right on inflation, or will they overshoot? Number four, recession or no recession? Soft or hard landing? Number five, the U.S. consumer is more indebted now than ever before. Can he keep fueling this economy on credit card debt forever? Number six, the national debt is now over $30 trillion, which works out to over $250,000 per taxpayer. How does this ever get resolved? Number seven, the Chinese economy has shown some significant cracks recently. What effect would a Chinese economic meltdown have on the financial markets and the world economy? Number eight, with the highest mortgage rates in decades and the COVID-induced but apparently permanent changes in workforce habits and the resulting large vacancy rates in big city office buildings, do you believe a real estate crash is a potential black swan event hanging over the banking sector and the economy? And number nine, and finally, any personal thoughts on Adam Smith's 300th anniversary? Unfortunately, Louis Navallier was unable to attend tonight due to a family matter. Fortunately, he has sent one of his top lieutenants from New York in his place. Now, before I introduce our distinguished guests, let me explain the format. Each will speak for 12 to 15 minutes. Then we will have a lively, open discussion between the three, where they can dispute or reinforce each other's arguments, after which we will open it up for audience Q&A. Our three guests tonight are Dr. Mark Skousen, editor of the award-winning investment newsletter Forecasts and Strategies. Mark is a nationally known investment expert, economist, university professor, and author of more than 25 books. In July 2018, Dr. Skousen was awarded the inaugural Triple Crown in Economics for his work in economic history, theory, and education. He is known as America's Economist and has been identified as one of the 20 most influential living economists. He has taught economics and finance at Columbia Business School, Columbia University, Barnard College, Mercy College, Rollins College, and Chapman University, where he is currently a presidential fellow and the Dade Spogli Endowed Chair of Free Enterprise. He has been a consultant to several Fortune 500 companies. In honor of his work in economics, finance, and management, Grantham University renamed its business school the Mark Skousen School of Business. He is a former analyst for the CIA, a columnist for Forbes magazine, and past president of the Foundation for Economic Education. He has written articles for the Wall Street Journal, Human Events, Reason, The Daily Caller, Christian Science Monitor, and the Journal of Economic Perspectives. He has appeared on CNBC, ABC, CNN, Fox News, and C-SPAN Book TV. He was formerly a regular contributor to Larry Kudlow and Company on CNBC. He is the founder and producer of Freedom Fest, the world's largest gathering of free minds, an event I would highly encourage you to attend. It meets every July in Las Vegas and attracts several thousand people from around the world. Next, we have Ivan Martchev, who is an investment strategist with Navallier and Associates. He is responsible for leading the sales process and allocating over $700 million of private client accounts into the firm's strategies. Previously, Ivan served as editorial director at Investor Place Media and has been the editor of Louis Rukeyser's Mutual Funds and associate editor of Personal Finance. Ivan's commentaries on markets have regularly been published by MarketWatch and others. Ivan is also the co-author of The Silk Road to Riches. The book provided analysis of geopolitical issues and strategy in natural resources and emerging markets with an emphasis on Asia. The book also correctly predicted the collapse of the U.S. real estate market, the rise of precious metals, and the resulting increased investor interest in emerging markets. Ivan at the University of Cincinnati and attended the American University in Bulgaria before finishing his undergraduate degree in the U.S. And finally, we have Paul Dietrich. Paul is the chief investment strategist for my firm, B. Riley Wealth Management. The firm now manages over $12 billion in client assets. Mr. Dietrich is an international corporate attorney and has been an advisor on privatization and economic development issues to the World Bank, as well as several governments in Asia, Eastern Europe, and the former Soviet Union. In his youth, before entering the practice of law, he served as publisher and editor-in-chief of Saturday Review, one of the United States' oldest cultural magazines. He also served for 4 years as an elected state representative in the Missouri General Assembly. In addition to editing an award-winning book, A Guide to American Foreign Policy, Mr. Dietrich was editor of the Reuters Emerging Markets Guide and the Reuters Asian Stock Sourcebook. He has been a member of the advisory board to the John Templeton Foundation. Sir John Templeton, as you know, was the legendary investor and founder of the Franklin Templeton Mutual Funds. Mr. Dietrich has been a frequent guest commentator on CNBC, CNN, Fox, and Bloomberg TV, and a contributor to the editorial pages of the Wall Street Journal, the Washington Post, the London Times, the International Herald Tribune, the Singapore Times, and Hong Kong's South China Morning Post. First up, we have Dr. Skousen. Thank you. Here's the controller.
Okay, let's see. The what? Is that it?
Yeah.
It's up, isn't it? Or no? Okay. Well, thank you. Paul, I look forward to talking to you. Did you know Norman Cousins? Oh my gosh, Norman Cousins. If you didn't know Norman Cousins, he was definitely talking about a liberal arts education. The guy knew a little bit about everything. And I really miss Saturday Review. That shows you how old I am, that I know about Saturday Review. I used to subscribe as a youngster in the 60s in Saturday Review. I loved it. It was really a great publication. We really have, when you look at the level of education in today's world, we're really dumbing down in so many ways. Present company. So my topic is, Adam Smith, the father of free market economics. He's celebrating his 300th birthday. How would you all like to live to be 300? So he's 300. I don't know where he is, but I do know where his cemetery is. So apparently he's there, waiting for the great resurrection that we're all looking forward to. But my question is, how much of Adam Smith's hand is visible. We all have heard of the invisible hand, but Adam Smith model is actually a real model. And the question is, how relevant is it today? How much of it is succeeded and how much has failed is my purpose. So as you all know, there was a Declaration of Political Independence in 1776, and of course there was also a Declaration of Economic several months earlier with the publication of The Wealth of Nations. And it was published on March 9th, 1776. 1776 was the miraculous year of the Enlightenment, and there's no better example than Adam Smith's Wealth of Nations. And what's interesting is some of you were looking at my own book, The Making of Modern Economics, which is my own, as you can see on the cover, is a tribute to Adam Smith. I believe he's the hero of economics, and all economists should be judged by whether they contributed to improving the house that Adam Smith built, or they want to tear it down and replace it. And there's economists in both camps. So mine is the first textbook that actually does this, that actually has a running plot, has a hero, wins and loses battles, is often left for dead and resuscitated by his heroes, and then is victorious in the end with the collapse of the Berlin Wall and the Soviet central planning model. And what's fun about this is the very first edition was published on March 9th, 2001. And I was thinking, why is that unique, March 9th? And it turned out to be the same pub date as this man on the cover, Adam Smith's Wealth of Nations. So I think my book has been inspired, and it's now in its fourth edition. So here we have a quote, which I can't read, but maybe I can come out here. Yeah, I can't really see it that well. But anyway, it says, every man, now here's the key. So there's one paragraph in this huge 1,000-page book of The Wealth of Nations, which summarizes the Adam Smith model. One paragraph, and it's on page 561, I believe. So he didn't put it up front. You had to discover it. And it's actually right after that he lists the 4 legitimate reasons for government. There's only 4. And we're up to 100, I think, in our country. But anyway, there's 3 elements to his model. Can you see the 3 elements? Okay, justice, freedom, and competition. They're all absolutely essential. You want to maximize freedom within the context of the rule of law and justice, but you have to have a really good, dynamic, competitive system. So he was very much opposed to giving monopoly power to companies. You had to have the competition. And if you have it, then you can achieve the highest level of opulence, he said. So there are 3 propositions in the Adam Smith model. One is that it will lead to higher growth, higher standard of living. 2, will benefit all rich and poor, not the inequality. Okay? And it will be a stable economic system. So if you see instability in the capitalist model, that's because somebody is intervening. You're not following the Adam Smith model of justice, freedom, and competition. Okay? So how successful has it been? Well, the Adam Smith model has been pretty successful because it came out in 1776, and look at what's happened since then. Now, correlation is not causation, but I will argue that the Adam Smith model is the one responsible for this dramatic rise in our standard of living since 1776. And also it's not just economic growth, but you can see the stock market long-term has been, despite bear markets from time to time, the stock market has been bullish for long periods of time. And the red line there, the red line there is U.S. It represents U.S. exceptionalism. For the last 100 years during the 20th century, the U.S. market has dominated. So American exceptionalism is apparent on Wall Street. Those are the other countries. And since the year 2000, it has still been the case. There's really no other country fund that has outperformed the U.S. S&P 500 that I'm aware of. Okay, so there are 5 elements to the Adam Smith model. One is it's pro-savings, capital formation, technology and entrepreneurship, supply-side economics. Number 2, you have to have limited government. Today we have unlimited government in a lot of ways, especially during a crisis. 3, fiscal policy, balanced budget, and low taxes. 4, monetary policy, sound money, and free trade. So Adam Smith said, little else is required to carry a state to the highest degree of opulence, but peace, easy taxes, and a tolerable administration of justice. Now, he left out sound money. He should have included sound money. He forgot, but that's okay. He said this in 1759. But do we have peace? Do we have easy taxes? And do we have a tolerable administration of justice? And do we have sound money? That's the way we determine whether the Adam Smith model is working or not. Okay, so how much of Adam Smith's hand is still visible? Well, we used to be highly protective. Protective tariffs were very common. It was the main source of income to the federal government. But as you can see, you've had a dramatic fall off. So this is the biggest success story of the Adam Smith model, is globalization and protectionism. And even, this doesn't show, it goes to 2017. So there is a blip up under Trump and continuing with Biden. But on a relative basis, it's still pretty low. And we have become a great consumer society because of our open policy regarding imported goods. And many countries have gotten rich on our society and because of this. This is the biggest Adam Smith success story. Now, the growth of government is a different story. That is in a bull market, and there's no indication of the law of diminishing returns occurring with government. Government is still growing, and there appears to be no leveling off of the size of government. Surely there must be a tipping point where we've gone too far and we need to reduce spending. Now notice that the only country that has not grown is what country in the last 10 years? Japan. That's the only one. And you know, they always talk about Japan being it's in recession, permanent recession, that is stagnating. Have you been to Japan? It is anything but stagnating. That place is such a fun place to be in. It's dynamic. You go into a home of a Japanese person, they've got every gadget imaginable. They have $100,000 in cash in savings accounts, in their postal savings accounts. So, you know, you need to visit these countries. All these economists who say the Japanese economy is stagnating, they need to go and visit these countries and see what's happening. Balanced budget, well, once the budget is not being balanced, it's completely out of balance. This is totally against the Adam Smith model, and this is very dangerous. This is leading us to a serious crisis at some point. We haven't reached that crisis yet, but with interest rates rising, the crisis is coming. We just don't know when. So we need to pay attention to that. And the national debt is something Adam Smith would be appalled in. Adam Smith would be delighted with the free trade that's going on, but he would not be happy with the size of government or the lack of, or the deficit spending. Sound money, so this is a great chart. This is a chart from Reinhardt and Rogar from Harvard, and they showed, and so I asked my students, okay, so you'll notice that inflation was not a problem until World War II, until Bretton Woods, World War II, what have you, the end of the Great Depression. Then we have permanent inflation. So anybody who thinks inflation's over needs to look at this chart. This is permanent. And I asked my students, okay, so why is it permanent? Is it because we have permanent military industrial state? Because notice that the only time you had inflation prior to World War II was due to what? wars. But then it changed after World War II. Was it because we have never-ending wars? Possibly. Is it because of the introduction of a central bank, which was in 1913? A lot of people think that's another factor, because while they were to defend the dollar, one of the purposes of the Fed was to defend the dollar, turns out it's an engine of inflation. So the other one is the adoption of Keynesian economics, which occurred after World War II. And what did Keynesian economics say? It's okay to run a deficit, especially during bad times. But even in good times, we run deficits, as we're doing right now. So Keynes left the barnyard door open, and that's a problem, okay? Could it be because we went off the gold standard and there's no discipline anymore? Could that be the factor? So I asked my students, and then I said, is it Bretton Woods? Because Bretton Woods was in 1944, and it kind of it made the dollar instead of gold. I mean, it linked it to the dollar, but it was one step removed. And so I asked my students all these questions. Which one is it? Okay, so which one is it? Of the 5 I mentioned, which one is it? So we asked our panelists, which one is it? What caused permanent inflation? Going off the gold standard? Anything else? Keynesian economics?
Constant growth in money supply.
Constant growth in money supply.
And that is related to the Federal Reserve.
Federal Reserve, creation of the Federal Reserve. It took them a while to get going, but
If you look at inflation before the creation of the Federal Reserve, and I can send you data from 1635, you will see that it's normal to have a 10% inflation year and 10% deflation year alternating.
kind of like what this chart shows, yeah.
But after the creation of the Federal Reserve, it becomes very smooth. The CPI index starts going up.
Yeah, interesting.
And that flipping between inflation and deflation has to do with the fact that the money supply is not constant when you are on a gold standard or partially on a gold standard.
Yeah.
And so between 1635 and 1913, inflation was like this.
Yeah, just like this shows. So I asked Kenneth Rogoff from Harvard, I said, so the students want to know, what is the correct answer? And they said, it's going off the gold standard. Because you actually see the bottom between World War I and World War II is 1933. And in 1933, FDR went off the gold standard. And then you have a dramatic rise after 1971. And what happened then? We went completely off the gold standard. So Richard, are you taking notes on this? I hope so. Okay. Adam Smith Model Index. Isn't this really cool? You all should know about the Economic Freedom Index that the Fraser Institute does and the Heritage Foundation. So they have 5 criteria to determine a level of economic freedom. 1, size of government. 2, legal structure, property rights. 3, access to sound money. 4, free trade. 5, regulation of business. And you notice this great chart showing countries that are least free grow the lowest, have the lowest standard of living, and countries that have the most economic freedom, the blue one, they grow the most. There's no better example. One simple chart for the Adam Smith model, and this is it. And it speaks volumes as to what government policy should be. Average economic growth rate actually kept rising until the year 2000 and can't tell what 7.0 is, but it was in the early 21st century. We kept having higher and higher worldwide economic growth, but then a series of crises caused it to drop. That was the financial crisis of 2008, and the lockdown caused economic freedom to decline. Now, maybe it's recovering now, who knows? I think so. U.S., not a good story. You can see we're in a secular decline in economic freedom. So that's the bad aspect. But Adam Smith's optimism, I really appreciate his optimism. He's never giving up, okay? You like somebody like Ronald Reagan who has a positive vision of things that no matter how bad things get, there's always that optimism. And I'll end this with this quote: the uniform, constant, uninterrupted effort of every man to better his condition is frequently powerful enough to maintain the natural progress of things toward improvement, in spite both of the extravagance of government and of the greatest errors of administration. I mean, that's positive. He's even positive based on this about Venezuela, because they have had the greatest errors of administration. And that country is a basket case. The richest country in South America is a basket case. So what are we doing? Where are we going in our economics? How is this happening with all the PhDs in economics, and we all have these majors in economics? Sometimes I feel frustrated as a teacher saying, where have we gone wrong? And one of them is a chapter in Marxism and communism. It's very dangerous. And I have a chapter in the middle of my book called Marx's Madness Plunges Economics into a New Dark Age. So you kind of know where I feel about Karl Marx. But he's very popular, especially in Latin America, unfortunately, in Venezuela as an example. So I've mentioned my book, The Making of Modern Economics. I have some copies in the back if you're interested. And I also have a book on finance that Rodolfo likes a lot called The Maxims of Wall Street, which is all the great quotes on Wall Street, like sell in May and go away and don't come back till Labor Day. There's lots of really great quotes. One of my favorite is, what's the definition of obscene profits? It's something you always hear about but never experience yourself. There's a lot of humor, satirical humor in the book. So if you're interested in that, might come back afterwards and pick up copies. And I'm hoping Rodolfo will give me a plug for that book. So anyway, thank you all very much. I think my time is up. I did want to tell you, you mentioned Freedom Fest. So this next year, Freedom Fest is in Las Vegas. We'd love to have you come. I have some cards back about the Freedom Fest, or you can go to freedomfest.com. And look at our title and tell me if that is not relevant to today. Are we entering a brave new world? That's the question. Thank you all very much.
Oh, you want to go back to my chart?
Yeah, here's the, there you go.
So I'm just going to go by the questions that our host posted at the beginning of the presentation, since I do believe they're important and they're probably on everybody's mind. And the first question is, does the rally we saw in the first half resume in the last quarter? And unfortunately, nobody knows that. The market was up quite a bit in June, and this sell in May and go away did not work this year. The market was extremely narrow between January and May, and then it broadened out, which is a good thing. But the largest divergence between the S&P equal weighted index and the S&P 500, which is market cap based index, was right at the end of May. And that's actually not good. Now, that has gotten a lot better, and during the summer there's a lot of noise. So right now I'm willing to treat the glass as half full after we get out of this period of negative seasonality, which typically ends in the second week of October. But I'm also mindful of the fact that the Federal Reserve did quite a bit of monetary tightening, and I don't believe that all that monetary tightening is in the economy. It's kind of strange to see the stock market rally when earnings are not growing, while the Federal Reserve is still hiking rates, and while the 10-year Treasury went above the high that we saw in October. And if it goes to 450, I don't think the stock market is going to like it. You know, there was a chart earlier on the 30-year mortgage rate, which is somewhere in the neighborhood of 725, 745, 750, depending on where you get a mortgage. My fixed rate mortgage is at 275. I'm not refinancing. and neither is anybody else. So since everybody's worried that the mortgage rate is going to crash the real estate market, there is a very unusual situation where high mortgage rates not only constrain demand, but they also constrain supply. So people with 3% mortgages don't want to move and get a 7% mortgage. So what ends up happening is the inventory of existing homes went down dramatically. The new home market is okay because some of the bigger builders are actually subsidizing mortgages. If you want to buy $1 million house from Toll Brothers, they'll give you a 5% mortgage. It's kind of a clever trick. But the inventory of existing homes is very low. And that's why you're keeping the price high. It's not a normal situation. Nobody expected mortgage rates to go from 2.75 to 7.25, and we'll see how long it lasts. Also, because we had this huge real estate problem back in 2006, 7, 8, the actual home builders consistently underbuilt for 15 years. So what ends up happening is if you look at different estimates, there's anywhere between 3 and 5 million homes shortage of underbuilt homes below the normal level of household creation. That's also supporting the real estate market. So I think the real estate cycle is very unusual. In theory, it could continue that way if we don't get a recession. Why are we not getting a recession after that much monetary tightening? That's also kind of puzzling to a lot of economists because most people thought we'd have a recession by now. We also have a shortage of workers. The shortage of workers, you can see it in the really low weekly jobless claims, unemployment rate and all that. How long it's going to last, who knows? But after that much monetary tightening, because we haven't seen the lags of the monetary tightening, we don't know whether the lags of monetary tightening are going to hit the economy in the first quarter, second quarter. We just have no idea. So no recession this year. The year's, we're already in the third quarter. Next year, we just don't know. We may get a recession. One indicator that I have found out to be reliable is the stock market tends to be very seasonally strong October, November, December. And before the last two more notable recessions in 2001 and 2008, in both cases, the market was terrible November and December. Those are really seasonally strong months. So if the market wobbles in such seasonally strong months, that's a canary in the coal mine that something is wrong. We did have a terrible December in 2018. Market went down 19%. I've never seen such a thing in December in a normal economy. And for that, you can thank the Federal Reserve. I think they terribly over-tightened. I think he didn't realize what he was doing, Powell. And when they kind of backed off and everything rebounded. So that is like an abnormal December, and then things kind of normalized. Is he going to over-tighten now? He may have already. It was way too much monetary tightening in a short period of time, so we don't know what the lags are. Were the bank failures isolated incidents or canary in a coal mine? My view of Silicon Valley Bank is it a failure of management. They grew very fast. They didn't manage their interest rate risk properly. And it was a mishandled the capital raise that they did in the middle of the week. I could have done that a little bit more diplomatically. Plus, there was a run on a bank, which is also abnormal. Because the company caters to venture capital firms and to startups, Somebody shouted fire in a crowded theater. They pulled $42 billion in one day, and the next day the request for withdrawals was $100 billion. No bank that's $200 billion in size can survive that sort of thing. So in this case, it's an isolated event because it doesn't deal with people with under $250,000 in assets which are insured. Deals with companies with millions of dollars in their accounts which are not insured. And I think Peter Thiel started that fire in a crowded theater situation. It's another story. There was also mismanagement on behalf of Silicon Valley. And then First Republic was guilt by association. Again, a lot of big accounts that are uninsured. So they were catering to wealthy clients. They got a lot of money. That money isn't insured. Money starts to leave and goes to JP Morgan, and all of a sudden JP Morgan gets the bank for free. So I tend to think that there's more mismanagement than a systematic problem, even though if you look at the assets that are in the hold to maturity portfolios that are not marked to market, it's a pretty sizable amount. To mark those assets to market, we have a problem. I don't think they'll do that, so we'll see. I think we can get out of this situation without necessarily a domino effect into the banking system, but the actual causes that resulted in the Silicon Valley failure and the First Republic kind of almost failure are still here. Okay, so is the Fed likely to get it right, or will they overshoot? I think they're overshooting already. I think inflation is already declining dramatically. I think the inflation situation partially is because of the Federal Reserve, partially is because of Congress. And I do believe what was done to prevent a domino effect in the banking system in 2020 was necessary. So if you shove $6 trillion into the economy via transfer payments to both companies and people, consumers, and they start spending when no supply chain is operating properly, you will get inflation. There's no other way. If you look at a chart of M2 money supply, which most people don't look at, that grew at a year-over-year rate of almost 27% between February of 2020 and February of 2021, when most of the transfer payments were made. It has never happened before. Most economists would tell you that the money supply doesn't correlate very well with inflation. That would be true when the economy is operating normally and you're not shoving $6 trillion in it in 12 months. That is obviously not true in our situation. Then we have a situation where money supply is now shrinking on a year-over-year basis. It has been shrinking since December 2022, every single month. That's not normal either. We've never had shrinkage in M2 money supply since the data is available. I believe the year when the Federal Reserve started making it available is 1959. So I don't think we'll have an inflation problem going forward. You know, wars and supply shocks with oil and all that, obviously you can't forecast these things. But based on the way the inflation rate is trending, the level of interest rates, what's going on with money supply, I think inflation is trending lower. I don't think the Federal Reserve should be doing more of what they're doing, but we'll see. My problem with Powell is very simple. He's not an economist. He overstimulates to the upside, and then he over-tightens to the downside. The problem is overdoing it. If we had Ben Bernanke, I also had problems with Ben Bernanke when he was in the job, but I think he's a spectacular economist, and he did things that only a spectacular economist can do. I don't think he'll be overstimulating to the upside and over-tightening to the downside. So it is what it is. Powell is a very smart man, but he's not an economist. And he does way too many mistakes for a Fed chairman. So now, I think if we do get a soft landing, which is possible, I think it's a 50-50 shot, he's going to look really good. no recession, declining inflation, mission accomplished. And we'll only know that, I think, by the end of next year. Other than that, it's too early to say. A recession or recession, I kind of answered that one. The U.S. consumer is more indebted than ever. That's always been the case. So, yes, credit card balances are out of control, but also unemployment is low. So typically, it's hard to get a recession with really low unemployment, and we have a shortage of workers. It's hard to get a recession with a strong real estate market. We do have that. A strong real estate market does support the economy with various channels. So we'll see. We might actually not get a recession, which would be very strange given how much intervention there was as far as monetary tightening is concerned. Plus, Biden did pass all kinds of acts, which is, I think, what is it, Inflation Reduction Act? It doesn't reduce inflation. Right. And there was all kinds of Build Back Better, or all kinds of stuff. But those trillions of dollars. And those trillions of dollars, they went out, got appropriated, but they don't necessarily get spent right away. So they get spent over, I don't know what it is, 3, 4, 5, 6 years. That does support the economy. It's almost like, paying for a good economy by the time you need to get reelected for president. Almost. So a lot of people don't consider that, and I do have a big problem with deficits in a good economy. You saw the charts. What happens to those deficits when the economy is bad? They get worse. I don't like the fact over the debt ceiling that leads them all the way to the edge, and then we get downgrades on the AAA credit rating. On the other hand, spending is out of control. So you don't spend out of control in the middle of an inflationary situation. That's what makes it worse. So we'll see. But on the other hand, if you look at how many years in this century we've had a surplus? 1. The last year of the Clinton administration. And it went downhill from there in both Republican and Democratic administrations. Every year deficit, good or bad economy. And everybody's got an excuse. We got a war, we got a financial crisis, we got COVID, we got this, we got that. How come every year we have this problem? For 23 years, 22. That's a lot of deficits. So that's why the national debt is 32 trillion dollars. It was not even 10 when Obama took over. So since Obama took over, and it's not his fault that we had a financial crisis, we've had a $20 trillion. It's ridiculous. So hopefully we'll find the right person to fix this, or the right party. Whoever fixes it has my vote. But it is a problem. And is my time up? Close. Okay, I'll wrap up. And okay. Any personal thoughts on the Adam Smith 300-year anniversary? The theory does work, but I'll give you an example where Adam Smith is completely disregarded, and that's China. They have something called state-sponsored capitalism. They had this explosive economic growth, and now they're hitting the wall. Chinese do not have free market capitalism. They have something called state-sponsored capitalism. So if you look at the Chinese stock market, it has been absolutely terrible in the last 15 or 20 years. Compare the Chinese stock market to the Indian stock market. Indian stock market beats it 5-1, depending on the time period you look. And that is because a lot of these companies are not for-profit enterprises. They sit there as a air traffic controller and direct trade flows and all kinds of other goods and services in the economy. They're not driven by profit, so therefore the stock market is a disaster. So I don't like tariffs, and Trump did take out the tariff card. But the way the Chinese manipulate trade flows, I don't know what else you're going to use against them. What they do is they very cleverly buy more from their friends and neighbors around them to increase their political influence, and they purposefully buy less from the United States, even though there's plenty of things to buy, but they'd rather steal them, like high tech, right? And they actually add to this deficit with this completely intentional direction of trade flows that if there weren't that much intervention in the Chinese economy by the Chinese government, they wouldn't be there. Not that large, anyway. Thank you.
Hi, everyone. I'm going to talk about some of the questions that you brought up in that, are we going to have a recession? How do you know? I mean, are we going to have a soft landing or a recession? Is inflation finally going down, or is it going sideways? And as of yesterday, could it go up again? Is the Fed going to finally start cutting rates, or is it going to continue to raise rates? And so you can understand how investors are confused about what's going on. And I, as someone who appears a lot on CNBC and Fox Business News and CNN, I get frustrated sometimes with the business press and how little economic education that a lot of the people who are on television, I often think they're there because they have a good voice, but not because they know too much. And it's been 411 years since the Dutch created the first kind of modern stock trading exchange. And then the British did it, and we've done it. But we have about 411 years worth of data. And in analyzing all that data, you can see certain cycles and certain trends. And I'm always amazed that people, kind of look at the stock market, but are not actually looking at the underlying economy. One of the things that we know is that anything can move the market up or down on a particular day. Russia going into Ukraine, the Fed raising rates. But the one thing that anyone who's taken an economics course knows is that in the long run, the stock market does follow the directional trend of the underlying economy. So if the underlying economy is contracting, guess what? We're going to see a bear market recession. If it's expanding, we're probably in a bull market. But it's the long term of the economy that you have to look at. I had a professor in college who says we make investing far too difficult. He says there's basically only two cycles. They're called business economic cycles. And he said one is a bull market expansionary economic cycle where everything is going up, earnings are going up, GDP is going up, the stock market is going up, everything is going up. And he always believed, he wasn't into passive investing, he believed that you ought to be full in the stock market during those periods of time. He didn't believe in a 60-40 portfolio. He just thought bonds just negatively affected your performance. On the other hand, we've seen bull markets historically since World War II. They last about 6 to 10 years, and then they're followed by a bear market recession, which is a contraction of the economy where everything's going down. Earnings are going down. Large parts of the economy are going down. New orders for manufacturing and goods are going down. And usually in the long term, not, we've seen recently what I call bear market rallies, or as some people call them, suckers rallies. And if you're in those investing at that time and you want to know who the sucker is, well, it's probably you. But the thing is that in the long term, the market is going down. That's the directional trend. And these bear market recessions, they usually last 9 to 18 months, and then we start another bull market again. And it always amazes me. He believed that the only appropriate thing for you to do in encountering these two economic cycles was to be sort of like a football coach. A football coach, you're either playing offense or you're playing defense. There is no in between. There's no passive investing strategy for playing football. You have different strategies, you have different plays, you even have different team players. And it would be a very stupid football coach who played his offensive team 100% of the time, whether he's playing offense or defense. And so my professor, and I agreed with him, thought that you needed to be appropriate to the cycle, just like farmers understand that you plant in the spring, you harvest in the fall, and you let the land go fallow, kind of the recession of the seasons of the year during the winter, and that you act appropriate to the cycle that you're in. And there was back in 1913 when the Federal Reserve was created, at the same time the government created a nonprofit research organization called the Conference Board. And the Conference Board spends most of all of its time tracking the economic cycles, basically the two seasons that we all find ourselves in. And they were designed to basically create an early warning system for when we were going into a recession and when we were coming out of a recession. And so what they did is they created leading economic indicators. They created coincident neutral economic indicators and lagging economic indicators. And this is where I find most journalists in the business community, most the anchors on most of the business programs on CNBC, they're completely ignorant of these cycles. If an economic report comes out and it's a leading economic indicator, everyone's all excited or depressed, depending on which direction they're going in. But the next day, there'll be a new economic report, like yesterday was the CPI, the inflation report, which is a lagging economic indicator, and the market goes up or what have you. But they don't understand that we go through these cycles of the 6 to 10 year expansionary cycle, and then it rolls over, and it takes 9 to 12 months to roll over into a bear market recession. The US economy is unbelievably complex and sophisticated, and it's hard to turn it on a dime, although they tried during COVID. But normally, when the market is in control, you have this 9 to 12 months rollover period. And what happens is that all the leading economic indicators, if you look at them right now, all the leading economic indicators are going down. Even the stock market, if you notice one of those charts, the stock market compared to its high, we're still below that. So it would still technically be negative, even though we've had the suckers rally for a number of months. But every other leading economic indicator is going down, But a lot of the lagging economic indicators are still going up because we're in this rollover phase. Lagging is coming up, all the leading are going down, and no one ever seems to make the distinction, and it really drives me nuts that people can't see where we're going. It's like driving and trying to steer your car just looking in the rear view mirror. You know, you're going to crash. There's no other place for you to go. So we have the leading economic indicators, and for over 100 since 1913, we have had, the conference board has a recession signal that it gives when we're going into a recession. And that signal went in the end of last September. And so the conference board's recession signal, it has 100% record in the last 110 years or so, has 100% being right in terms of calling a recession before the recession happens. It is an early warning signal. It's usually, on average, 9 to 12 months before a recession hits. And again, it wasn't designed for investors. We all get so frustrated. When is this recession coming? I wish it would come faster, get it over with. But this was designed for CEOs. And if you have a major corporation like GM or something like that, you need to know in advance when there's going to be a recession, when there's going to be a downturn, and you want to get it as early as possible so that you can go from 3 shifts to 2 shifts. You can you can pull back your inventory and your new orders, all of those sort of things. And so it's enormously helpful to CEOs, the conference board's system of calling different business cycles as they happen. But as I said, they have 100% record. It's not 99%, it's not 98%, it's not 90%, it's 100% being right in terms of calling recessions 9 to 12 months in advance. One of the leading economic indicators, and again, they're leading economic indicators, there are 10 of them, they're widely diversified in every industry. So if all of them are going down, and they're going down on a consistent basis, we've now had 16 consecutive months of the leading indicators going down. How in the world do you have an expansionary economy when that is happening? It's not possible. And so they've called it, and as I said, one of the leading indicators is an inverted yield curve. And when the yield curve inverts, when that happens, and there have been so many academic studies on this, it's usually a 9 to 18 month in advance warning that we're going to have a recession. And since World War II, basically, they have a perfect record of calling recessions 100% of the time, not 90%. And so we're going to have a recession. I don't understand why people don't like recessions. As an economist, we look at recessions as a period to cleanse out all the bubbles and all the excesses of the economy. And if you don't think we've got some bubbles and excesses in the economy, you haven't been paying attention. I mean, cryptocurrencies, give me a break. I know Miami is now the cryptocurrency capital of the world, but there's nothing there backing, talk about nothing backing a currency.
You like the dollar?
I like it better than the crypto. I know people say that there's nothing backing the US dollar, but actually there is. It's the willingness of about 98% of all the workers in America to pay about 15% of their salary even before they get it. It's taken out and sent to the government. And about 98% of most corporations last year paid about 20% of their profits. So the US dollar is kind of a call on the US economy. And, if GDP goes up 3 to 5% a year. Probably the dollar expands, even though it's relative, we know, because it's not on the gold standard. I support the gold standard, but you can't say that nothing backs the US dollar. It is backed by all of these people paying their taxes. And that's not the case with the European currency. If you're an Italian and you pay your taxes, you pay it to the Italian government. You do not pay it to the European Central Bank. The only thing that's backing the euro is the vague promises of both France and Germany to basically come to the aid of bonds that are going out. And it depends on how much you trust France and Germany. That's the level of your confidence in the euro as a currency. And China, well, I won't even get into that. They don't really have anything real backing their currency either. Anyway, just to go back, we are going to have a recession. I know people have talked about a soft landing. It's never happened before. It's happened once. Everyone sort of agrees that in 1993 and 1994, Alan Greenspan, we had a very hot inflation, and he raised rates and then kind of lowered them so we didn't go into a recession. But no one mentions, and this is the illiteracy of our business journalists and anchors on CNBC and Fox Business News, is that they never mention we had just come out of the 1991 recession. So we were in a bull market, and the bull market got hot, and inflation came up, and Alan Greenspan raised rates and brought it down. But we were in a bull market during that period of time. We were not even going into a recession. The conference board had not 9 to 12 months before given an early warning signal that we were going into a recession. There was no inverted yield curve at that time. So there were no signs that we were even going into a recession. And so this was all done during a bull market. So if you do a serious study of soft landings, there is no history of a soft landing when we were going into a contraction of the US economy. Now, I suspect, as was mentioned, that because of all the money that was pumped in by COVID and infrastructure, and the fact that we have full employment, but I will also say in 1973 to 1975, back during the Carter administration, we had a recession. We were paying for all the money we printed in the Vietnam War and in President Johnson's Great Society spending programs, and we had the Arab oil embargo that same year, which caused a lot of inflation. So I always think that was the recession that's closest to what we're about to go into. And we had unemployment kept going down for 7 months after Niebuhr called the recession date. So we've had examples where unemployment continued to go down during a recession. And so I don't know that, having full employment is, you can't have a recession without it, because we certainly have in the past. And so there is no history in a contracting economy like we are in now, where all the leading economic indicators are going down. There has never been a soft landing, and I don't believe there will be a soft landing. Now, but because of all that money, we could push the recession, because people are still spending a lot of money, into early next year. So it could go into the beginning of next year, but I'm sure that everyone's going to be saying, yes, we had a soft landing in the last quarter of this year, and then the bottom's going to drop out. And let me just tell you this. The average, if you look at a chart of all the recessions for the last, since the 60s, you will see the stock market goes up right until the recession actually starts. and then it drops. We have never had a recession where the stock market has gone up. It doesn't happen. That's why, we've been in an earnings recession now for 3 consecutive quarters where earnings have continued to decline, as Ivan mentioned, and the stock market is going up. How does that work? It's something that happens during suckers rallies, but it's not sustainable. And so the average recession has had a 36% drop in the S&P 500. But you look at our last 2 major recessions, the dot-com recession in 2001 and 2002, that was one of the, sorry, my mouth is dry. That was one of it was a recession that was one of the mildest recessions in U.S. history. It was only 7 months long, so 2 consecutive quarters in a month. The GDP didn't go down 1% during all that. It was a negative, but less than 1%. But the stock market went down 49% from the peak to the bottom. And in the last recession, 2008 and 2009, from peak to bottom, it was 57%. The S&P 500 went down. The average is 36%. We're now down about 10% from the peak last year. So we got another 26% that the S&P is going to go down once the recession starts. And as I said, I don't know when, but probably we might push it off until the first quarter of next year. And then we're going to see a drop because we always see a drop. There's never been a recession where the stock market has gone up.
Well,
So let me just, I'll end it there.
thanks for cheering everyone up, Paul. I'd like to ask Yvonne and Mark if you have any comments on Paul's comments. It seemed like both of you were wanting to jump out of your chair here.
So first of all, Canada, by the way, knows how to do immigration properly. They're bringing in skilled workers by the hundreds of thousands, and we're not. Number 2, China's success was not due to adopting state capitalism. It's because since 1980, they adopt free market capitalism. And Neil Ferguson did a really nice job on this, showing that that you saw China used to be 80% state capitalism, state ownership. Now it's 20%, and that's the reason why China has grown. It's because they adopt free market capitalism. They still have state capitalism, but it's much lower than what it used to be. I think I'm the only one who has a textbook, Economic Logic, that highlights the Conference Board's 10 leading indicators. It is not taught in economics courses that I've seen. And it is so critical to understanding the business cycle. I'm really glad that Paul brought this up because I use it a lot. And consumption by the consumer indicators are not part of the leading indicators. They're all in earlier stages, supply side. They do have the consumer expectations index, but it's based on business. They've added the business. They ask consumers about outlook for business, not whether they're spending money on entertainment. And finally, I do have a great quote from the Maxims of Wall Street about looking in the rearview mirror. There's a great quote, an Italian quote, that says that the first thing you do as an investor is break off the rear view mirror. Or he says when you're a driver, you break off the rear view mirror because you want to look forward. And I think the inverted yield curve is a really good indicator of, I don't think it's 100% though. I think there have been a couple of times where the inverted yield curve did not really bring about a recession or a serious recession, but most of the time it has.
And not the 3-month,
10-year,
that has a perfect record.
And also I should say that the inverted yield curve is not very inverted. I mean, the short-term rate is a little over 5%, and the long-term rates are close to 4%, and the mortgage rate is 7%. So you don't have a very good inverted yield curve. And I also think we underestimate the boom in technology, which is really ramping up with AI and chat, GBT, and all of these things can be used actually in a very positive way, not negative. And you said the economy is very complex, and it really is true. So it is still possible that we can have a mild recession, and maybe not a soft landing, because I would agree with everybody here that the Fed overreacts every time. They are too easy for too long, and they're too tight for too long. And finally, the dollar is strong. Taxes are one issue, but it's also a world currency. Never forget the dollar is the world's currency, and that has had a big factor in keeping the strength, keeping the dollar around. Oh, you got it.
I have it. So it is true that all leading indicators are pointing down, and I think the conference board has been the longest period of pointing down these indicators. And there's also something called economic, which is a similar type of organization, but I think a little more proprietary, and they're also pointing down. So all these guys, if you tell them we won't have a recession, they'll just say absurd. I don't think there is depending on how bad the recession is, I don't think the difference between a soft landing and a mild recession is very big, in my view. If we get a recession without a sharp rise in unemployment, I think everybody is going to be fine. But the weirdness about this suckers rally is that it came without a rise in earnings. Earnings estimates have improved somewhat, but the whole thing was multiple expansion. And it was very narrow, and it's gotten a little better. So there are problems with the rally. Typically, markets don't go up sustainably unless earnings starts growing over time. It can happen over 6 months, a year. I don't think it's going to happen much longer if earnings don't start to grow. Because these are expensive multiples. If you look at where the S&P is trading, there is a little bit of a distortion there. Because everybody quotes the multiple for the whole index, and people don't account for the fact that the index actually has a 17 forward multiple, which is not bad, and there are 10 companies in the index that are so huge that they distort the whole multiple. Because it's market cap based. When you go Apple's, Google's, and all Microsoft's and all that, and they pull the whole multiple higher. And those are kind of unique companies. So is AI going to change the world? Is it going to be better than electricity? It may be, you know.
The Economist has a really good article on that.
Yeah, it may be, but it's not going to be this year. Right? It's not going to be this year. And also...
But one reason the stock market's going up really fast is because lately this suckers rally that you call it, which I don't think it is, but AI is a big driver behind Tesla going up, getting buy signals, Microsoft, Google, Amazon. They're all working with AI in a positive way, and it's happening much faster than you were expecting.
Oh, go ahead.
Arnold Schwarzenegger is famous for his Terminator film, and there is artificial intelligence called Skynet that tries to wipe out the world.
Right.
That's what people are worried about.
Is that what you're worried about?
No, but,
okay. Well.
but Elon Musk and all these big guys from Google and all that, they were
worried about that.
they were on Capitol Hill.
Yeah. Well, we don't know all the ramifications
Right,
of AI.
we don't know.
That's the problem.
We'll find out.
But you make a mistake. I think one makes a mistake in equating AI with the stock market or the economy. I mean, we had the same thing during the dot-com recession, where the internet has changed all of our lives, probably most of us, I think, for the better.
Yeah.
And yet, almost all the companies at that time who were profiting and had high PEs, even though they had no earnings and all of that, they all disappeared. And that's the same thing. You can't equate AI, which I actually do believe is going to change the world, with the companies that are
But
doing
these,
it. You have
but the-
NVIDIA that
but the
has
A-
115
NVIDIA is
now.
making money, though. It's not
It
a
is.
no earnings kind of
No,
model.
it is, but it's 115
And
times
Microsoft
earnings.
is making money, and Apple is making money. Name me one of these AI companies
Yeah,
that doesn't
mu-
have
yeah,
revenues.
but almost all of them are not making money off of AI. AI is given away
No, but
for
they can
free,
afford.
and
They
they're
can
Google.
afford to do it. Is
Yeah,
what
but
I'm
th-
saying.
but that's the problem. They're not making money off of AI. They are introducing it, but they're giving it away for free. NVIDIA actually makes money, but it has 115 PE. You're paying 150 years of annual earnings.
That's true. We can say it's overvalued.
Yes.
Certainly.
I mean, I've
A
been
lot of people have made money on overvalued stocks.
There is a famous strategist, Richard Bernstein. He deals with institutional brokerage, who said that it is the internet made the U.S. economy a lot better. But if you bought a year before the peak,
Q&A.
which was 1999, then it took 11 years for you to break even.
Yeah.
So you also have to pay attention what you're buying and when you're buying it. So yes, I think AI is going to be great, and we're all going to have a robot at home to talk to, but it's not going to be this year.
Okay, I think we're going to have a little Q&A from the audience now, but I'm going to start with one for Mark. Mark, you've been recommending uranium stocks
Yeah.
recently, and I'd like to have you explain your rationale behind that.
I brought copies of my newsletter, by the way, so if you want to see my latest headline, the new bull market in uranium. So come up here and get a copy of the letter if you'd like to see what I'm saying there. But uranium has been a long time in a bear market, and it's had these rallies from time to time. But I think at this time it's real because of the green revolution that's going on. You've got in the equation, you have to include the most productive form of energy creation. And, wind and water and sun, it doesn't cut it. It has to be heavily subsidized. And I don't know how long it's going to be. But uranium, the nuclear power plants are 8,000% more productive than fossil fuels. So this is in a new bull market. I don't know how long it's last. It's probably speculative fever that's going on. I was showing you that these stocks are up 30, 40, 100% in the last year. But we're right in the middle of this bull market. So I think it's got a ways to run.
Very good. Any questions from our audience?
Hello. Just going back to the regional bank crisis that we experienced, and I guess talking about interest rate risk management, do we see the possibility or there's signs of contagion, or what we saw maybe in the European financial crisis in the early 2010s happening again? Is Europe next from a regional bank interest rate risk management perspective?
So Europe has a very different banking system. It's much more concentrated. The banks are much larger, more regulated. You can't say they're better run if you look at their share prices. But on the other hand, they had a very weird interest rate regime where you had negative yields at one point. That's, by the way, a central banking maneuver. I don't think it helped them all that much because it killed the profitability of the banking system. And when you do that, you also kill credit growth and all kinds of other things, so it doesn't work. And Japanese banks, you don't want to look at their share prices. Now they're getting better for legitimate reasons. So my guess is those banks are better run than Silicon Valley. And they're not as lopsided, they're more diversified, and they got other ways to make money. There was a pretty bad sovereign debt crisis in Europe back in 2011 when Greeks defaulted. If you know something about Greece, is they were spending, drunken sailors were a joke compared to the Greeks. And they're not only spending, also hiding their debts. So they didn't know how much the Greek economy was indebted. And when the whole thing came out, they just couldn't pay. It's kind of like filing a personal bankruptcy. And Greece is recovering, it's growing. Yes, they don't make more money than in 2010 because they don't borrow to pay their civil servants more money. It's more natural right now. I think Greece is going to be fine. But Europe at large, it's not. It's more rigid than the United States. They've got their own different system, confederate, if you want to call it that, the European Union.
Let's keep our answers a little
I would
briefer
just mention
so we
one
can
other
have more
thing.
questions.
I actually think that there's always a catalyst that causes the stock market to go into a bear market or crash or what have you. And we saw an inkling of this earlier in the spring with the regional banking crisis. And I don't think it's over because most of these bonds, most of the bond portfolios that the banks have are unprotected. They're not hedged. And that means they're going down in value. And all it takes is a bunch of wealthy investors like Elon Musk or whoever to pull money out of these banks, and you're going to have another banking crisis. So it is something that could happen. I'll never forget 1982 when the stock market was going down and bond prices were 21% and so forth. And the Fed did not pivot until the Mexican banking crisis. And the Mexican banking crisis forced the Fed to lower interest rates, and that's when the Reagan boom started. So I think that sort of thing is something that could happen, another banking crisis.
Yeah, I agree with Mark. One of the things that keeps me up at night worrying is exactly this. We have two regulatory systems in the US for banks. We have the too big to fail banks, and they have to mark everything to market. And 70% of commercial real estate is financed by regional banks, and they can lie to their customers legally about their capital requirements. As Mark says, they haven't hedged, and that was the big problem with Silicon Valley Bank. But even worse than their treasury bonds that they bought, back when there was no interest rates, it's the loans that they have. If you look at the big banks like Citibank, they've marked down 39 to 41% of the value of their real estate loans. I do not know of one single regional bank that has marked down the value because of defaults and because they can't refinance. And every month in New York, you're seeing some very big buildings where the owners are saying, look, I'm 30% empty. People, as they're coming up for their leases.
48% empty in New York City.
Yeah,
on average.
Exactly. I was doing a national average, but they are coming in and they're saying, I refinanced at 2% the last 20 years or so, and now I'm at 8%. My business model for running a building just doesn't work anymore for a commercial building. And so they're handing the keys back to the banks. And this is the problem that we're going to see. And let me tell you what I think will be the Lehman Brothers moment, is that in Tulsa, Oklahoma, or some city in the Midwest, the biggest building in the skyline which is 40% empty, is going to go for refinancing at 8% instead of 2%, and they're just going to hand the keys back to the bank, and the bank is, what
And
is
there's
it
no
gonna-
buyers
gonna
for-
do with it? And people are going to have a run on that bank, and when that happens in Tulsa, you're going to see it everywhere. Because all of these regional banks are just a disaster in terms of being transparent to their customers. You got a question back here, guys? No. Yeah.
Well, I'm glad you guys are finally getting to that, 'cause that was question 8 on my list when I first started the commercial real estate problem.
Thanks a lot. Question on, so markets have evolved a lot. Now markets, we have a lot of younger participants. Options volumes are exploding. We saw meme mania in early 2021. Last year's bear market, every time we had some volatility, the buy, the dip crew came in. We've been seeing it a lot this year on big down days. A lot of times the day ends flat. Curious as to the role of the younger investor and stocks becoming more interesting to the younger cohorts of the population. Thank you.
So having more people involved in investing is a good thing. I don't think meme stocks are investing. That's pure speculation, okay? Exploding options volumes, in our case, means depressed volatility. And the reason why that is the case is because the explosion in options volumes, which you don't see in the aggregates, is half of it comes from something called 0 day to expiration option, something that gets listed in the morning and ceases to exist at 4:15.
Day trading.
Well, it is day trading and it isn't. They're supposed to be traded from the short side because the decay in the price is so big, and if it's out of the money, it goes to zero. But because it's become also an institutional business, shorting options means shorting volatility. The volatility in the market gets suppressed in a very weird way through all kinds of games that if I can talk for hours.
Okay.
So
We have time for one more question, and this young lady up here in front, Francisco, had a question in the black. Oh, I thought you had a question. I'm sorry.
I would just say, he's got a question.
Oh, Ed has a question.
One last question for Mark and all of you. If free market economics, as outlined by Adam Smith, is so successful, and I agree it has been so successful, and if the Berlin Wall didn't fall down, it was torn down by the East Berliners, the Soviet Union gave up, they didn't shoot anybody, they said, to heck with this doesn't work. If the Gulag Archipelago is true, then why do we have this great attraction for socialism today? I mean, Mark, you had your Freedom Fest in Memphis over in July. Over Labor Day weekend, Democratic Socialists of America had a big convention in Chicago. What's going on?
So I do think people need desperately to educate, and I do have another. I do give a talk. My wife and I give a talk called "What's Better Than Democratic Socialism?" And why is that a very attractive title? Because you get all these young people coming saying, well, could there be anything better than Democrat? I got to listen to this talk. And of course, when we're through, we say democratic capitalism. And it's more of the John Mackey conscious capitalism. It's a stakeholder philosophy, a win-win-win for everybody. And it is an ideal. And so we do need to educate people more on this kind of thing. But capitalism has still won this war. There's no question about it. When you go into the stores and you compare it to Eastern Germany or Eastern Europe or the Soviet Union, when you go into stores and you order and you get one kind of bread and it's black, and it tastes good, but it's only one kind of bread versus 150 kinds of bread that you get in the United States, the quantity, quality, and variety of goods and services. I mean, capitalism has won the materialistic war. What they haven't won is these issues about inequality, okay, and the global warming issue and all that sort of thing. That's where the battle is being fought. But the fundamentals are still a very strong capitalistic model. But taxation to reduce inequality, all of the attacks, regulation, this is where the threat is. It's not in the ideology.
Well, let's have a big hand for our fine panelists today. Thank you, and thank you, the audience.
Thank you, Rodolfo, for hosting, and thank you, everybody, for coming. We still have some time here. If you want to hang out for about another half hour, feel free. There's plenty of food and drink around. And again, if you want to learn a little bit more about the Economic Club, visit our website, economicclubmiami.com, or talk to one of us before you leave today. Thank you so much for being here, and thanks to all of our panelists.